Hi, everyone. In today's video, we're going to discuss Advisor Alpha. I don't think you can have a comprehensive planner that does not look at taxes. And a lot of the old school, more traditional advisors will say, hey, I can't give tax advice, or we're not going to let the tax tail wag the dog. And I think that is just the absolute wrong way of looking at things. Everything that we do has some sort of tax consequence. The main takeaways here are if you're a DIY or if you're working with an advisor and you're not doing these things, you might be leaving money on the table. Starting from first principles, I think that most people, they initially think that taxes work like this. They just go up little by little, the more that you make. And in a lot of ways, it is true, but there's a little bit more nuance to that. That was the effective rate, but really the marginal rate is what is more important when you're doing tax planning or you're looking at what to do this year versus a year off into the future. As you can see here, you've got the standard deduction, that first $33,000 for a married couple, 0% tax on that. That's the off the top deduction. That's why you see it going from left to right, from 0 to about 30,000 in the 0% tax bracket. And it's a stair step system. Every additional dollar gets taxed at a different level. That's why they call it the marginal system. The next 23,000 at 10%, 70,000 after that at 12%, all the way up to 37%. Level 1 is that effective tax bracket. Level 2 is knowing the marginal system. But then level 3 and 4 are a combination of understanding that when you're in retirement, a couple of years out from Medicare, they start looking at your modified adjusted gross income to figure out if they want to tax you additionally. They call it the Medicare surcharge, just an additional fee that I look at as a tax that if you go over the cliff, you have to pay incrementally. From 0 to 212,000 in modified adjusted gross income, you don't have to pay anything initially. And remember, you got taxed on your Medicare. Medicare was a tax every year while you were working. By and large, it should be a free benefit, but it's another way to help the Medicare system stay afloat by taxing those that have a lot of income. Here are the different cliffs. You can see this is saying 2027. Because we're in 2025 right now, the taxes this year will relate to the 2027 Medicare. Let's not forget about the state taxes. A lot of my clients in Texas, we don't have to worry about this because we have higher property taxes. But my friends in Oklahoma and Colorado, California, et cetera, have the state taxes to deal with. That's an additional amount above and beyond the federal taxes, something to keep in mind. And then we have capital gains taxes as well. We talked about the ordinary income taxes. That's what we've been talking about up to this point. There's also capital gains taxes. They run in parallel, but the taxation is different. You get preferential treatment on your capital gains. That would be selling your assets at a gain. The actual taxes themselves are on different systems, pretty wide bracket, and then 15%. And then it goes up to a 20% bracket as well, which you can't see because it's off of this chart. But what you can see is the net investment income tax too, which most people don't know about whatsoever. That's an additional 3.8%. And then maybe two more things to add. We're not going to talk about it in this video. It's not as relevant to what we're discussing, but if you have assets in an irrevocable trust, they have their own tax system as well if you're keeping it in the trust. If you take it out, it's going to go into your ordinary bucket. But the irrevocable trust, those brackets are really compressed. So you get into those higher brackets a lot more quickly. There's also the estate taxes that we have to think about as well. That's when someone passes. If they're giving away more than 13 million, there's a really aggressive tax on any dollars after that, as high as 40% tax there. These are all the things that we're working through to try to mitigate for our clients before they become an issue. All right, let's go back to our marginal brackets. And all this stuff is great in theory, but I think it makes a lot of sense to look at it in practice so that we can work through a case study together so you can see how things change. And it's not as easy of a picture as you might imagine. In this example, we're going to look at a retired couple in their 60s. They're close enough to Medicare. They have Social Security, but in total, they want to spend $15,000 per month. We're going to look at what their tax situation might look like. First and foremost, let's say they turn on Social Security, 60,000 between the two of them. Maybe one spouse has a $40,000 benefit and the other spouse has a spousal benefit, which is half of the others, 40 and 20. That's 60. That's their baseline. Social Security in and of itself is not taxable until you have other income that stacks on top. On our X and our Y axis, on the Y axis, we've got the rates, percentage they are. But you're going to see the X axis shifting as we bring more income into the scenario. It's going to basically be moving from right to left. You'll see it shift out of the screen as we get closer to incurring taxes. Social Security still at a 0% tax, got a little bit more room in the standard deduction to work with, but you can see the additional purple added there. And that is because Social Security can be taxable. Up to 85% of it can be included in your taxable income. A lot of people, if they're only living off of Social Security, not going to be an issue at all. But once you have $44,000 of income, 85% of the benefit is taxable. All right, let's add our interest income. A lot of my retiree clients, they do like having some cash on hand as a buffer between them and the market. In this scenario, I'm just assuming 250,000 of cash on hand. It's about 18 months of expenses. High yield savings account at 4%, 10,000 a year. They're using up more of the standard deduction, but still no taxation yet. All right, next, qualified dividends and non-qualified dividends. In that taxable account, they have bonds. We're just assuming they're in a 60-40 type scenario, and most of their dividends are qualified. Those do get the preferential long-term capital gains rates. However, 5,000 of them are non-qualified. Not ideal, something we'd want to try to avoid, but those are going to be taxed at their ordinary income. You can see our graph is starting to shift. We've gone through the standard deduction. Now our Social Security is being brought into our tax situation. We're not only paying that 10% on the next dollar, but it's really 18-20% because Social Security is also going to start being taxed. You're starting to see some of the nuances here. Let's also now add in 20,000 of long-term capital gains and 5,000 of short-term capital gains. Now, we can avoid those short-term gains, but in this scenario, it's something that I see quite a bit with prospects coming in. They're not completely dialed in yet from the tax perspective. It's not anything outrageous, but again, you're seeing this start to shift. We're almost through Social Security being fully taxable. We're getting into the realm where the long-term capital gain and the qualified dividends, that 40,000 is represented in red. That's not taxable yet, but we're getting pretty close to that being included in this sample client's tax bill. We're in the 12% bracket at this point. It's actually way higher than that when you include all these different things. They need some income, 180,000. We've got to take IRA distributions as well. IRA distributions are taxable as ordinary income, and this shifts things pretty substantially. We burn through all of that purple and red portion. 200,000 of income, 21,000 of taxes. We got pretty close to that 180,000 number. That is the base case. That's what they want to spend. But they say, Joe, you know what? I've heard that Roth conversions are a really smart thing to do. And I really want my assets to be able to grow tax-free off into the future. I know that it's a really good inheritance tool. And all those things are true. But we also have to understand, what are we going to pay today versus paying later? A Roth conversion to fill up the 22% bracket, $90,000 to get there, and a $21,000 tax, 23.8% tax. You saw that on the first 200,000, we were taxed at 21. And on the next 90, we're taxed at 21. That's just going to show that, hey, we're getting into these compressed areas where every extra dollar is being taxed a lot higher. It's 23.3 because the net investment income tax is coming into play. But then additionally, above and beyond that, you see these Medicare cliffs that we will exceed if we do this $90,000 conversion. And that surcharge for the two of them, that's $2,643 a piece, $5,287 for the exact same Medicare coverage that they had before. But based on their taxes this year, 2 years from now, they're going to have to pay that. I look at that as a tax, right? It's called a surcharge. It's money out of your pocket. And it means that really it's about a 29% tax when it's all said and done. Again, this is what I see all the time. And there are some small nuances that can really add up here. What I would do working with this client is to dive into their tax situation. There are a ton of people that come to my firm that already had an advisor and they weren't doing these things, but there's so much low hanging fruit. And we're going to look at how I would help them avoid these so that we can save on taxes and then bring in Roth conversions a little bit more prudently. This next chart, I've struck through a few of the items that I think we can do without. I think we can do better. And what I've also am showing here on the side is an example 1040. These are two separate scenarios. The one in the middle on the left-hand side, that was the base case. And the one on the right is where I think we can clean some things up. I've added in tax exempt interest and I've taken out the taxable interest. Now, the reason for that, a lot of people have too much money, in my opinion, in these high yield savings accounts. You're getting 4%, and that's great based on the last few years of super low interest rate environment, not being able to make any money on your money. But let's say you do want to have 18 months of cash on hand, you're taxed on those funds, as we saw. 4% really becomes 3% net after tax to you. What we could do is take those funds from the high yield savings, put it in a municipal, short-term, high quality investment vehicle. It may make 3%, 4, 5%. You could be ahead on a gross basis and certainly on an after-tax basis. Moving on, let's talk about qualified and non-qualified dividends. Not a lot of people know the rules behind non-qualified dividends, and it's unfortunate to see. I just took them out altogether from this scenario. But moving forward, short-term and long-term capital gains, the exact same thing. Long-term gains, they're certainly going to happen from time to time. But with the volatility that we've had in the market, most people are able to also tax loss harvest some losses along the way. I think that we can get out of it tax neutrally. The end state is 14,000 of taxes. You're seeing 7,000 less in taxes, 33% reduction. By not doing anything crazy, keeping the risk the same, but just prudently working through tax planning the way that it should be done. So let's take a step back and we'll go back to the scenario that we had. And that was a $90,000 conversion at 29%. That's going to cost $26,000. Well, now in our new scenario, because of these optimizations that we've done along the way, not only are we saving taxes, but our whole graph has shifted less to the side. And you could still try to fill up the 22% bracket, but you've also got about $50,000 here that you could do a Roth conversion at 22%, not go into the next Medicare IRMA bracket. You wouldn't have to pay the net investment income tax. I just wanted to hammer home this point that there's a difference between the taxability of investments and the accounts that they're in. Bonds are generally going to be taxed at ordinary income tax rates. Stocks, they could be at ordinary income if you have the short-term capital gains or the non-qualified dividends. But generally, when you have the long-term capital gains or qualified dividends, you're going to pay those preferential capital gains rates. And then the taxability of accounts, tax-deferred accounts, IRAs, 401ks, et cetera. Everything that's happening within those accounts, there's no taxation. There's only taxation when you take money out of those accounts. Roth, the exact same way, nothing going on in the account, but no taxation when you take the money out because you already paid the ordinary income taxes on the way in. And then lastly, taxable accounts. And I think taxable accounts get a bad rap because they're taxable every single year, but that's only an issue when you're bringing forth those taxes. If you're doing the right things like tax loss harvesting, not selling short-term gain positions, not incurring non-qualified dividends, you can really keep your taxes in the taxable account to a minimum. In practice, what does this look like? Well, everyone has stocks and bonds. It might make more sense to put the stocks in the Roth and taxable accounts because that's where, on the taxable side, you get preferential treatment. On the Roth side, that's going to be the last funds that you probably touch. You want the higher growth assets in there. And then you might want to put the bonds in your deferred accounts because bonds do get tax ordinary income. But if they're in this tax deferred account wrapper, it won't matter. The only thing that matters is the amount of money you take out of the account. If your advisor is putting you in a 60/40 across all account types, that would really be a red flag for me. And I would want to ask some questions because that is very unoptimized. You've got to think about your asset allocation at the high level. And then once you have that allocation, all of the different account types, where specifically should you put those? Technology is so great today that you can really easily monitor and rebalance these things. There really should be no excuse anymore to not using tax location to your advantage. Bonus item here for those that are charitably inclined, there are a lot of great ways to give to charitable organizations without just giving cash. Pre 70 and a half, you can utilize donor advised funds, or you can just give appreciated shares directly to charity. A donor advised fund is a really good tool for my retirees in that last year or so of retirement. They're in their highest tax bracket generally. It might make sense to fund a donor advised fund that year when they're in the 35% bracket. And maybe they want to fund the next 10 years worth of giving, take the deduction in that year, have this separate donor advised fund account that they can give from over the 10 years. And then once they reach age 70 and a half, you can use what's called qualified charitable distributions, QCDs. And a QCD is taking money out of your IRA and not having to pay the ordinary income taxes on it. And this is awesome because you're able to give to charity. You never pay taxes on the money. The charity never pays taxes on the money. And that account of yours is going down so that at age 73 or 75, whichever one is your RMD beginning date, you don't have to take as big of a required minimum distribution. And when you have reached your beginning date and you are having to take these, the QCDs act as the first piece that is taken out of these accounts to help satisfy your requirement for the year. And then last piece, giving money to a charitable organization via the IRA from a tax perspective is certainly the way to go at death as well. You don't have to separate it out as a secondary account, but it is certainly one option you could do along with just naming the beneficiaries respectively. In summary, though, I really hope that that helps. No one is comprehensive if they're not doing real tax planning. And don't let your advisor pawn it off on the CPA who doesn't know your situation or even have the ability to be able to do this on your behalf. Make sure that you're working with someone who takes tax planning seriously because you can really reduce your tax bill today and into the future and optimize around your different legacy giving as well, all of which help make your plan as successful as possible. I know that was a lot. No one likes taxes, right? But they're incredibly important. They're really important to me in my practice. If you have any questions, feel free to reach out. Otherwise, part 2 is going to be on investments. And I think that some of the things from this video will really shift into that one as well. Thanks, guys. I'll see you in the next one.